Alright, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video here, I'll be walking you through a couple of things here that will show you just how ridiculous stock market valuations have gotten to this point. And so what you're seeing here is the Wilshire 5000 Total Market Index. Now perhaps many of you have not even heard of this index before. Most people, when they think about a market index, they think about the S&P 500, the Nasdaq, the Dow Jones, the Russell 2000 maybe, but not really the Wilshire 5000. This index is definitely a lot more unknown. But in my opinion, it should be one of the most important indexes because, as I'm sure you can tell by the name, this is the total market index. Right? The Dow Jones, for example, only includes 30 stocks. The S&P 500, it's only 500 stocks. The Nasdaq 100, obviously 100 stocks. But the Wilshire, however, at least when it was first created, had 5,000 different stocks in it. And as of today, I think it's around 3,800 or so. This index has changed quite a bit. But the fact of the matter is, this index here does include way more stocks than any other main index, and therefore gives you a very complete picture of where the stock market is today, or at any point in the past. So the time frame that you're looking at right now is basically between 2011 all the way up to the end of 2019. And for the most part during this time, obviously the market has climbed higher, as it's been doing for the past 10 plus years or so. So nothing really striking to see in this time frame. But now if I scroll ahead to where we are now, hopefully just by looking at this visually, the market has gone to absolutely astronomical heights. This move here, ever since the bottom of February and March of 2020, after the market crashed, has not only dwarfed any big move higher in the past, but there really has not been a single significant breakdown lower, or even just a time of consolidation, or just range-bound action. It's just been a relentless, insane climb higher. So I just wanted to show you this first just to give you some perspective as to where we are situated right now with the stock market. And so before I continue here and show you the really scary thing about all this, is I just want to let you know that you can also find me on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check those out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. And so like I was saying, the very scary thing about all this, if I now come over here, and we take a look at the market cap to GDP indicator, also known as the Buffett indicator. And that's because Warren Buffett himself said this particular chart is one of the best single measures of where valuations, where company valuations stand at any given moment in time. And actually you can see down here in the interpretation of this graph, you can see that quote by Warren Buffett is actually mentioned in this paragraph down here. And you can actually go to the Fortune magazine article where he actually said it is the best single measure of where valuations stand at any given moment. And so all this chart is doing is it's simply taking the Wilshire 5000 index and dividing it by the US GDP. And in case you are not aware of what GDP is, it stands for Gross Domestic Product, and it's simply, if I scroll in here or zoom in, GDP is simply the total monetary or market value of all the finished goods and services produced within a country's border during a specific period of time, typically over a quarter or 1 year. Right, so everything that the United States produces within 1 year, all the goods and services that come out of the US, we're just adding up the total value of all those goods and services, and that's the US GDP. So like I said, coming back to our first tab here with this chart, we're simply taking the Wilshire 5000 index and just dividing it by the US GDP. So we're essentially trying to compare the value of companies relative to the products that they produce. And as you can see right now, the ratio between these two things has gotten to a value of almost 2, 1.929 to be exact. So we're basically saying that all the companies within the Wilshire 5000 index, which is the majority of publicly traded companies, are valued at almost 2 times the value of everything that is produced in the entire United States. Keep in mind also that there are many, many more companies than just 5,000 in the US. And like I said earlier, the Wilshire 5000 index only includes about 3,800 companies at this point today. So if you ask me, I think this level of valuation that we're at right now is insane by itself. How can just a handful of companies in the US, albeit some of the biggest companies in the US, how can they be valued at more than 2 times everything that is produced by the entire country? Now, of course, there is the argument that company valuations do include this thing called potential, where essentially because a certain company has the potential to do amazing things in the future, that's why we're still giving it a greater value today. The market is forward-looking in that sense, but at some point, you're just going to hit a level where valuations are just totally unrealistic. And the true scary thing about this chart here is when you compare it to where it was back in 2007, right before the housing market crash, and also back in 2000 when the dot-com bubble blew up. Right back in 2007, this ratio was only around 1, meaning the Wilshire companies were valued at about the same as GDP, not twice the value. And then back in 2000, when the valuations of tech stocks and internet stocks were just getting to absolutely ridiculous levels, the ratio between the Wilshire 5000 and GDP was at about 1.3 or so. And then of course, after this chart peaked during both of those time periods, everything came crashing down. So now that we've reached a valuation of almost 2 times GDP, in my view, one of two things has to happen here. The first thing that could happen, and I think is much more likely to happen, is these valuations have to come down, which means the stock market is going to have to come down. Now, I would never be so arrogant as to try and predict when that would happen. I'm not going to try and call the top here. This chart could go to 3 for all I know. This massive uptrend we're seeing could continue for another 6 months, or a year, or it could end tomorrow. I have no idea, and there is no way to predict that. But the first scenario that I think is much more likely to play out is the stock market is going to have to come down significantly. I don't think it'll be in a straight line, although as we saw back in 2008 and back in 2000 and 2001, I do think it will come down rather swiftly. The alternative thing that could happen is US GDP is going to have to explode. It's going to have to increase at a very significant rate, which if that does happen, and it certainly could, then these valuations here might be more justifiable. And also by taking the ratio between the Wilshire and GDP, since the denominator here is GDP, if this were to increase significantly, that will bring down the ratio. And that can happen without the stock market moving that much at all. So this would be the happier scenario. The stock market doesn't crash, or we don't enter into a bear market, and we simply come out of this coronavirus pandemic with a very strong economy that will probably have to be the strongest economy that we've ever seen before. Otherwise, in my view, these valuations are just not justifiable. So ultimately, the point of this video here is just to raise awareness of where we are, where we stand with the stock market, and also just to share a bit of my opinion. And so again, I'm not trying to scare anyone into thinking that we're about to crash tomorrow. Like I said, it could be 6 months from now, a year from now, 3 years from now. I have no idea. All I'm saying is that given where valuations are right now, and just given what the stock market has been doing over the past 1 year or so, I think just logically speaking, just being intuitive, most people would agree that this is going to have to end at some point. Because if you look at the past, every single time the market has gotten away from itself, which you can see here, and here, and here, so on and so forth, every single time the market gets too high, what does it do? It comes back down. And so that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you've got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.